Hello and welcome to Module 18, where we're going to talk about federal deposit insurance. So in the last module, we talked about deposits, and the reason banks are able to attract deposits is because of federal deposit insurance. As you hopefully recall, federal deposit insurance was created in 1933, created the Federal Deposit Insurance Corporation. And it now applies to all state and federally chartered banks. At one time, there were some state insurance funds, but in the 1970s, many of them, including Ohio's, became insolvent, and it created too much disruption really in the economy. So now all state and federally chartered institutions must have FDIC insurance. And this creates this idea of moral hazard. I refer to the fact that you can access financial information about banks publicly on the FDIC website. It's required to be reported quarterly, but it's rarely viewed by most people, particularly individuals, and it's probably or arguably because there's FDIC insurance. And that is the concept of moral hazard. Would it be better if we didn't have FDIC insurance and we all watched the financial stability of banks and chose our bank based on their financial stability, which we were able to access? I don't think that's going to happen, but it is something to keep in mind. And it really came up with some of the bank failures in early 2023, when many individuals had uninsured deposits, and the federal government stepped in and in fact made those individuals whole, which is interesting because it does relate to this idea that's out there, and which is largely true, but not necessarily true, is that will the government back up banks above the deposit insurance limits? So it seems that they will at times. So FDIC insurance covers all deposit accounts. So it's checking accounts, savings accounts, money market accounts, CDs. It doesn't cover, of course, any type of financial products, insurance, annuities. That may seem obvious, but some of these companies get in a bit of trouble by making their disclosures unclear. And so if you're in compliance, it's very important that when you're advertising, or if you have something that deals with insured and uninsured products, that it's very clear to individuals which products are insured and which are not. And in fact, we've had problems where crypto firms have given consumers the impression that they are covered by FDIC insurance, which obviously they're not. So it is an important compliance consideration, even though it would seem that it should be obvious. Currently, the standard insurance amount is $250,000 per depositor per insured bank for each ownership category. So, thing to keep in mind is that there is unlimited insurance for any individual, because if you go to enough institutions, you get as much insurance as you want. So the categories tend to be single accounts owned by one person, joint accounts owned by two or more. Certain types of IRAs are covered by FDIC insurance, revocable trust account, and you look at the beneficiary, business accounts, looking at the business entity, irrevocable trust accounts, again, looking at the beneficiary, certain employee benefit plans, if they're held in the proper manner, as well as government accounts that are custodial in nature. And so it really shows you that you can get quite a lot of insurance, one, by holding various types of accounts, and two, by going to different types of institutions. Interesting to see how the amount has increased. And this also relates to what happened in 2023. Started out at 2,500. It went up pretty quickly. It was a while before it doubled, added another 5,000. And then we see a fairly long period of time between 1980 to 2008 where it was only at $100,000, which really wasn't even a lot in 2008. And so we did see it go up to $250,000. After the financial crisis, so it went up during the financial crisis, and after the financial crisis, during the recovery period, the FDIC actually offered unlimited insurance if the money was put in certain types of accounts between the end of 2010 until the end of 2012. And this was to keep money in the banking system, and it was a pretty effective way to do that. So you think about it, the FDIC essentially is an insurance agency. They're insurancing these thousands and thousands of institutions with these limits. And so the question comes up, how much money should the FDIC keep on hand? How many bank failures are there going to be? And that has been debated. And this is in the law. Of course, it's set by Congress. And for quite a long time, it was just a straight 1.25% of insured deposits. But interestingly, in the early 2000s, it was believed that the economy was so good and so strong that it was really wasteful to have that much money sitting in the Federal Reserve banks. That's where the FDIC keeps its money. And it said we need to lower it to 1.125. And if it gets above 1.5, the banks need to get rebates because banks are charged an assessment. That's how the FDIC gets this money. And so interestingly, this was adopted in 2006. And as we know, 2 years later, there was a financial crisis. And so then in the Dodd-Frank Act, it was increased up to 1.35. And there are no longer these rebates. And so in 2010, it did take 10 years for the FDIC to get back up to that 1.35 level. Because they were really, after all the bank failures, they did not have a lot of cash on hand. And so it really gets to this idea that it's hard for all of us maybe to remember, but that sometimes it's okay to keep money on reserve during good times, because that's what we saw was that prior to 2008, it was thought that, oh, these times are such good. Why are we having all this money sitting in the bank? And very quickly, the economy kind of tanked. And so we're sort of potentially, still struggling with that, because in the years after 2008, it was we could remember that lesson, I guess, but as the longer we get from that, it's harder to remember that lesson. And I hear more talk about, maybe these reserve ratios are too high again. But the Federal Deposit Insurance has designated its goal is to really keep 2%. So while the law requires 1.35, the FDIC is keeping 2% currently. And so it's really a difficult challenge, obviously. And anytime, if you've watched any of these bank failures, which are in the news, the FDIC, obviously its goal is not to take over banks. Its goal is to have banks survive. And its goal also is to keep the appropriate amount of supervision and oversight, and also keep the appropriate amount of money on hand to deal with bank failures. And so here I've just shown sort of in the 2000s, it's kind of a funny chart because the left is more current. But, we have years where we have no bank failures, oftentimes followed by years with a lot of bank failures. So if you look over here, as I mentioned, there was a real thought that after 1999, we had the perfect banking economic system. And you see that we had 4, 11, 3, 4, and 2 years with no bank failures. That is really what led to the idea to decrease the reserve ratio. But then, of course, in 2008, we had the financial crisis really coming on at the end of the year, so that the largest number of failures were in 2009 and 2010, and then kind of slowing down. Then it starts to seem like things are getting to a better place. We're still having some bank failures, surprisingly few really during the pandemic, but then we had 5 in 2023. I have another chart though that will show you that the number of failures is really not the whole picture, because not all banks that fail are equal. And traditionally, the banks that do fail are the small institutions. But in 2023, that was not the case. And also was not the case even in the 2008 financial crisis. And so what we really see is that in the 2023 failure, where we only had the 5 institutions, they really had a lot of assets. And that is why it was far more concerning than it would normally be, because we see, I think in 2016, we also had 5, and not a big deal at all. It's very easy to deal with 5 bank failures when you have such small institutions, which is what you typically see. And so this also this is just a 2023 chart where we see that the 2 big banks that failed in March were really very large, and not at all the types of banks that we see failing. And so what the FDIC typically tries to do is to sell off the assets. And really, ideally, they do that without taking over the bank. Many banks that would fail are actually sold before they're failed. And sometimes the FDIC exerts a little bit of pressure on the purchasing institutions, but they also oftentimes sweeten the deal and give them some other benefits. But this just gives you sort of the lay of the land of the 2023 bank failures, and really how large the Silicon Valley Bank and even the Signature Bank was fairly large. But what was also very interesting was these were business banks. And so most of the deposits were not insured. And so this really raises that issue, is what is the point of deposit insurance? At a $250,000 per depositor, it's very clear this is designed to help regular folks so that you and I don't lose our money. $250,000 is really nothing for a business. No business can run payroll without having accounts in excess of that amount, typically, unless they're, a handful of employees. And so what we saw with Silicon Valley Bank was a bank to, tech startups. And these were not well-capitalized companies necessarily, and they weren't going to be able to make payroll because largely the deposits were uninsured. All the insured depositors, of course, are immediately made whole. But the government did decide in that case to step in and make all depositors whole. And that raises that moral hazard issue. Does that make people not think about where they're putting their money? Because even though they're only obligated to insure up to $250,000, do we now think, we know they'll come in, they'll insure it regardless? I don't think that's necessarily the case, but that is, the argument and the concern. But obviously, in the moment, it's important for the bank regulators to make a decision. And what is important to keep in mind is they're not making a decision, hopefully, for the benefit of Silicon Valley and its investors. They're making a decision for the benefit of the economy. And also, arguably, the individuals that would be paid out of these business accounts that were actually uninsured. As I mentioned, the FDIC is run by the assessments. Had a very simple assessment system prior to 1991. It was just a certain kind of percentage against the deposits. In 1991, it was decided that really banks should pay different amounts based on their risk. If you're a really strong bank, why should you have to pay more? And so essentially, it left most banks not even paying an assessment, and the assessments are really falling on the riskiest banks. Well, after the Dodd-Frank Act, it became clear the FDIC, one, needed more money, and also that the largest institutions, because they don't have the deposits as a larger percentage of their, liabilities, asset calculation, that it really wasn't being fairly applied, because the large institutions actually pose a greater risk to the economy. And as we very clearly see, they really pose a much greater risk when they fail. When small institutions fail, it's very easy for the FDIC to come in and pick up the pieces. And so now the FDIC does the assessment based on assets. And they look at all types of assets, again, the contractual arrangement type of assets, as well as the traditional loan assets. So the Dodd-Frank Act really shifted the assessment base to basically make the larger banks pay more. They're still risk-based. They also have a large bank system and a small bank, and we're seeing that more and more in bank regulation, having to divide banks because the large institutions are so different from the small institutions. And so the risk criteria is very different. And they also hit the larger institutions with special assessments on the theory that essentially they can actually potentially withstand that. Also true that during the financial crisis, a lot of the large institutions got some real cash infusions from the government. So it did seem somewhat fair to make them pay some of these special assessments to get the FDIC on more solid ground. I did ask you to look at one question in this reading. It was on page 518, and it really is asking about the purpose of FDIC insurance, because it is per person, per institution. So the question is the FDIC insuring, which is protecting the depositors, or the solvency of institutions? And I think if you think about really what we've discussed through this whole semester, you see that when the FDIC is looking at risk and looking at solvency, they're looking at it for the benefit of the banking system and the individuals that use the banks, that is the US economy and its citizens and its businesses. And so that is why there is unlimited deposit insurance. You just have to break it down into $250,000 chunks, which individuals may be able to do unless they're a very high net worth. But businesses really can't operate that way. So I think it does show you that currently deposit insurance is really designed for the protection of the everyday depositor. Please let me know if you have questions. Thank you for listening.